Hi guys, if you're here. Alright, so in this video, we're going to be talking about technical analysis based on managing your risk. Alright, so before then, please make sure you're following me on all my socials, especially on TradingView, YouTube, Twitter. You can also come over here to find my other offerings to support the work that I'm doing. So you could follow the free mailing list for the Nigerian share picks, and I'm currently working on the paid version. The free version just gives you a list with the low risk, medium risk, high risk. The paid version is going to even give you my analysis on and review on a weekly or monthly basis. So we'll see how that goes in the future. I'm excited about it. I'm working on that. All right, so we'll just move into what we are talking about. Okay, so basically, here's what I'm trying to say in this video. All right, so you must always look left. As an investor, the very first thing is you make sure that your time frame is on the weekly time frame. Very important. Now, I'm going to be using what is called the hiking ashi. Now, and I assume that anybody that is following me on TradingView already knows how to use TradingView, so I'm not going to go into that. So here are my thoughts when I'm thinking about buying a stock. Now, and I'm using some of the picks for the third quarter picks, and Dangote Sugar is one of them. Okay, so currently, this is where the price is, right? You always want to look left. Before here, where did the price come from? It came from this bottom, all right? When I was buying or when I decided to buy Dangote Sugar, what did I have in mind? I had a buy zone. I had an area of where I felt was the best place to buy. So as soon as price left this buy zone, the next things I was interested in was take profit at this point, and the next thing was take profit at this point. So we're not going into those reasoning. I just want you to have a risk management knowledge. But I also just wanted to throw that in there that you must have an idea of your buy zone, what prices are you entering at, and when you enter the prices, what prices are you taking profit at? Very important. Okay, so this is the current price of Dangote Sugar, right? Around 61. Where did it come from? Over here. So, what are the possibilities? So, it's possible that even though you met price here, it's very possible that price can come all the way back here. So, your risk at this point is that prices can come all the way back down here to this level. That's your risk. So, it means invariably that you're possibly better buying at halfway through, right? So this is like halfway through, and it means that if you bought here, your risk will just be that it can come all the way down here. So if you bought all the way down here, what's your risk at this point? It means that price can come all the way down here. And if it leaves all the way down here, what's the worst case scenario? Price can come all the way down here. So if you bought here, it's possible that prices can come all the way down. It's just possible because price action can do whatever price action wants to do. All right, so I hope that wasn't confusing. That's what I look at. But I'm going to give you another example. So we'll use Dangote Cement. Let me use Dangote Cement as my next example. So current price of Dangote Cement. This is where the current price is at, right? Where is it coming from? This is exactly where it's coming from. At this point, where is it coming from? Over here. And from this point, where is it coming from? Over here. And from this point, where is it coming from? Over here. So for me, this would be the most interesting portion. This is where I'll be interested in buying Dangote Cement because worst case scenario, it will come back down here. So my risk at this level just means that it will come back down to this level. But my risk here means that, well, it could still come back down to this level over here. But my buying here means that I risk that it can still come back all the way down here. So I hope that's understand. That's what I look at. How low can it drop? So now imagine buying around here and look at price where it came from. That's a massive drop. So why would I want to buy at that point? Why would I want to buy here? Look at where it's coming from. Instead, if I'm really interested in investing, I will stagger my buy. If I came and met it here, I'll say, okay, I'll wait for it to come halfway through. So halfway through is somewhere here, probably buy here, right? If it continues to go down, so I keep lowering my risk. That's how to think about these things. All right, so let's look at Ella Lakes. Okay, I already had this one drawn out. So the current price of Ella Lakes is just around here. Where did it come from? Came from here, right? So it means that it can drop from this point to this point. And you can say it's impossible, but it's price action. It can happen. So it can drop from this height all the way back down to this level. So are you not better off buying halfway through, which is right here, so that your risk can just be halfway through as opposed to buying right here? So what if it doesn't come back here? Then that's fine. You leave it be. It's another missed opportunity in the market. But are you better off being at risk or missing an opportunity? That's for you to decide. Okay, so I'll show you two more examples. So this e-transact is right currently right here. This is where the price is. Where is it coming from? Right at this bottom. Is it high risk? Yes, because it can drop all the way down here. Where are you better off buying? Probably better off buying halfway through. So halfway through is somewhere here. So that even if it drops, the drop is just here. So this is where I'll look to buy if I was going to even come back and buy e-transact, right? But it's left for you. Okay, we've been talking about the ones that are high risk. Let's look at something that is low risk. Okay, so this HM call, where is the current price? Current price is right around here. What's the worst case scenario? It can come back down here. Now look at this movement from here to here. It's almost negligible. So how do I choose where I want to take profits? So if price is here and it came from here, where did it come from? Came from this point. From here, where did it come from? This point. From here, where did it come from? This point. From here, where did it come from? This point. And from here, where did it come from? Let's call it this point. So it means that even though the price is here, it has a chance of coming back here. So from here, can come back right here, can come back right here. And if we're even lucky, it can come back over here. So I hope this is not just a lot of confusion, but you are trying to catch what it is I'm trying to give out in this video. You must always understand how low your investments can drop. And that's what this video is all about. You want to manage your risk. There is always a tendency to think that technical analysis is a tool for prediction, but it's actually a tool for planning. You can literally see how I have planned my risk. How low can this drop just because I'm looking technically at the price action? Where has it been before? Where's the possibility of where it can go to? And that's what technical analysis is all about. It's not to predict, it's where has it been to before and where are the possible places it can go to. And then how do I plan based on what it is that I'm suspecting? All right, so I hope this video was helpful to you. Let me know. Drop me your questions if you have any, and I'll see you in my next video.